we believe the outlook for risky assets, notably equities around the world, is fairly challenged for the coming 12 months, with the key issue being a lack of earnings momentum rather than elevated earnings multiples themselves. In this respect, this lack of earnings growth is coming through principally as a result of muted top-line growth due to very slow economic growth, together with the fact that operating margins, especially in places like America, are particularly high relative to history. In the global context, we're expecting 5% total returns in dollars from global equities, whereas in South Africa we're looking for roughly 12% total returns from the domestic index. The first quarter of 2016 has seen a dramatic reversal in fortunes for many sectors across the JSE, with resources in particular proving to be the leader of the pack in 2016 so far. We do not believe that this rally has been based in sound fundamentals, with significant fiscal stimulus juicing up the Chinese economy and consequently steel consumption in the first quarter of this year. However, when looking at longer term fundamentals, we believe that excessive steel consumption in China, which is roughly 10 times per unit of GDP compared to that of the US, has to ultimately normalize, with the result that demand for steel making raw materials is likely to grow at a slower pace than that of supply, where we still see significant supply growth coming through in the next few years. As a result, we believe that resources shares are not underpinned by sound fundamentals on the supply and demand side. Looking across to other market sectors in South Africa and the JSE, we believe that industrial rand hedges have largely run their course from the perspective of earnings multiples, which means that the stellar performance that we've seen to date over the last few years, if it is to be continued, needs to be driven by earnings growth rather than multiple expansion. And specifically, we would point to this group of companies as a general rule, trading at roughly a 60% premium to that of the rand plays, which is things like banks and retailers and insurance companies, even if one excludes Naspers, which obviously skews that index significantly to the upside. And when comparing our rand hedges even to a global index such as the MSCI World Index, we're talking about a premium of more than 20%. So it's hard to conclude that our globalized companies trading on the JSE are trading at very cheap levels or even fair value relative to their global peers. Banks saw a significant re-rating in the first quarter of this year, which has taken their multiples back to broadly long-term averages. But we would also note that the cost of money, given recent political events in South Africa, has risen, and the growth profile of these businesses has likely worsened over the next few years. In summary, we believe that the sharp sector rotation which we've seen in the first part of this year is unlikely to recur for the remainder of the year, which means that stock selection on a bottom-up basis is likely to be more important than it's been in recent months and years.